great being here in Vilnius, Vilna. We have our paper on loan commitments with Mac. I'll do the initial part, then Tzvi will continue with the model. And actually, people in finance don't understand this issue, this form of loan commitments. And I think that all of you will be surprised. If you would have more time, we would ask you questions about what is the size of the loan commitment, undrawn loan commitment in the United States. So here you have the solution. You see the progression since 1984. And today we are talking about $10 trillion. Trillion, like I explained to Willie, is 10 to the power of 12. Okay? So it's almost the same size as corporate loans by banks in the United States. It's a huge amount. It's about one half of the GDP of the United States. Now think about it, that the banks are charging about 0.5% per annum on the unwithdrawn balance. So it's money coming to the bank as income. They don't have to put money behind it because it's a commitment. It's a contingent claim. So how much is 0.5% of $10 trillion? It's a lot of money, income, to the banking system, without actually committing now the cash needed. So we are talking about a huge segment of the financial system that, in our view, is not treated, and it's not in the textbooks in finance, amazingly enough. So much is being talked about, bonds, etc., but this segment that is so important is sort of being ignored. Okay, to see some examples, real-life examples, here you have from Amazon, a 2023 report. They speak about 1.5 billion secured revolving credit facility. If you look at the prices, okay, here you have the commitment will, once they exercise it, it will be 125 spread over a certain rate. And they pay a commitment fee of 0.45% per annum. So the big Amazon with a very nice high credit rating still pay, without using the money, about 0.5% per annum. Okay, and look at what is highlighted here. The estimated fair value of the credit facility, which is based on level 2 inputs, approximated its carrying value as of December, so it's very close to the fair value. The notional value is close to the fair value, but they also deal with it, and for the accountants among us, it's not treated accounting-wise, it's not in the balance sheet, it's only in the explanations, in the footnotes. So it's off-balance sheet item. So also for corporations, they can have huge amount of credit facility as long as they don't exercise the option, as long as they don't turn it into a loan, it's a contingent claim only in the footnotes. So if you don't search the footnotes, you don't know about this credit exposure. Here we have another one, Boeing. Again, pretty sizable amounts, 3 billion, 8, 10, 3, yeah, we are talking about big numbers for Boeing, and Boeing needs a lot of money, as we know. They had all kinds of difficulties. As of December 31, 2023, we had 10 billion currently available under credit line agreement, so it's an issue. Okay, so we are talking about liquidity management. It's part of companies have cash, they may have short-term securities, and usually they have also credit lines as part of the liquidity management. And it has cost, as we saw. It may have some time consuming, also to raise money. It's time consuming and costly, so we have to look at the mixture, the portfolio of tools available for corporations in managing their liquidity. So they are used as a buffer against unexpected short-term cash flows, cash flow gaps, the gap between income and expenses. Also for unanticipated investment opportunities, so it's opportunistic. So actually, what is confusing sometimes, and we'll find it in the literature, it can be used offensively to find new opportunities and to grab them, to exercise and buy some new opportunities. But it can be also used defensively by corporations as a hedge against interest rate changes. And we'll focus more on this aspect of credit lines. So in our paper, it's a tool, short-term, in liquidity management. Okay, so the motivation for the paper is that it's enormous quantity that is sort of outstanding. There's also another issue concerning credit lines, which is called MAC, material adverse change, giving the banks an option to bail out. So they provide the commitment, they get paid for it. But if the condition of the company getting the credit line is changing adversely, they can bail out. It's not specified when they can bail out. And we know empirically that they hardly use it, this clause, but they have it. So I guess that in case of a major crisis, they will use it. And probably they use it only in time of a major crisis. Okay, so actually there are three sources of uncertainty in the literature. The first source is a short-term external macro rate, like the T-bill rate. It's floating, it's changing, so that may be a source of why companies want to mitigate against, for example, interest rates going up. So there's many papers dealing, sort of pricing it in a sense, but looking at the T-bill rate fluctuations. The second one is looking at the credit spread or the rating of the specific companies that is getting the credit line. And we are in this area, but we do it internally. Our solution, our model is solving it internally, based on the condition of the company over time. And the third one is future investment opportunities. For example, there are a series of papers by Acharya, Almeida, and others, that they look at the offensive approach. I mean, the uncertainty about new investments that are appearing in the market, and you want to exercise this growth opportunity. So three different sources, completely different models in this sense. So here you have a literature survey. I'll let you read the paper or the papers behind it. So it's really, yes, they are looking at contingent claim, not exactly in option. Some are doing sort of binomial, very strange binomial trees to capture some of the uncertainty. And you see what is highlighted only briefly. Some look at loan commitments as completing the financial markets. Adding another dimension to cash holding or short-term borrowing. So that's another way, because it's not borrowing. As I said, it's off balance sheet. So it has some advantages, but you pay for it. Okay, it can be liquidity protection, liquidity management, LCR, viable liquidity substitute only for firms with high cash flow. By the way, let me highlight this Sophie, which is an empirical paper. He shows something that also Alcharia and Almeida are showing, that usually good companies, high-rated companies, are using loan commitments. Banks are happier. In Acharya Almeida, it's from the point of view of the banks, and they provide the loan commitments to good companies that have a lot of cash. So it sort of sounds a little bit awkward. And usually companies that are stripped of cash need to use cash management. They don't get the loan commitments. Okay. Here we have another paper. Access to lines of credit is not a perfect substitute for cash. And it also depends not on the credit quality of the company, but also on the financial condition of the bank, which is usually being downplayed in the different models. Those are the papers by Acharya and Almeida that I just mentioned. Okay. Here we have another recent paper. It was written on behalf of the Fed of New York, and they focus on banks' funding risk. So it's not from the point of view of the corporations, but more from the bank's point of view and how it's related to the LIBOR rate or the SOFR, the new rates. Okay. Let me see if... So in our model, the source of uncertainty is the value of the firm over time, how it's changing and how the credit risk is changing. So we assume more or less the Merton model that Zvi will shortly describe, and how we do all the internal is an internal solution from macroeconomic point of view, focusing on the company that is taking the loan commitment. Okay, as far as IFRS, accounting-wise, they are not reported in the financial report, only the footnotes as and here you have the IFRS rules, IFRS 9, that usually, under certain conditions, it's only in the footnotes, it's less than a year, etc., you don't have to report it on your balance sheet. So the accounting view for those interested. Okay, our major contributions in the paper are four. First, we derive the analytical solution, microeconomic equilibrium-based no utility functions. Second, the analytical solution is application of the compound, the option, call and put and call, as you'll see it. A little bit more complicated. Let me only tell you, you have two options on the two sides. You have two truncations. So it makes it more complicated, and as a result, many of the results are non-linear, non-monotonous, as we'll see. Third, the major source of uncertainty is the riskiness of the assets of the firm, reflected on the credit risk on the loan of the company. And we introduce and price also the MAC. We show different MACs, different conditions, how they are affecting the pricing of the loan commitments. And finally, small advertisement for series of books with also Michel Coury, our co-author. We collected about 70 papers on contingent claims, starting with Black-Scholes and Merton, and all the famous papers, including equity valuation, debt valuation. We are great believers in the contingent claim approach to corporate finance. I don't think that the way we teach today corporate finance is correct, complete, and You're invited to order it to your libraries at the universities, but it's really a pretty complete set of papers over the last 50 years. So we will continue now with the model. And you need this one.
Okay, thank you. Don't worry. Okay, so let me continue. I have like 10 minutes left. So I'll try to explain very generally how the model is built and what is the major result. So we start with the Mertens type model. There is a time axis and value of assets. The blue point is the current situation. The company has the value of assets above its debt level, so the company is solvent. As long as time passes, the value of assets changes. It's a stochastic process. Sometimes it goes up, sometimes it goes down. Theoretically, it can cross the blue line. Since nobody can see the current value of assets, they are not reported on a daily basis, then it can either go to a bad state, or maybe we are lucky and we will end with a non-default path. So at maturity of the debt, we must pay the debt, so everybody will see if we are solvent or not. So this is the basic setting of Mertens model. Now we change the axis. Now the horizontal axis is the value of assets, and the current value of assets is something, let's say A, and the distribution of the value of assets, the probability distribution by the end of the period, by the day we have to repay our debt, is a nice looking or less nice looking bell-shaped distribution. As long as we have a certain level of debt, so here is the level, D is the level of debt. If at maturity of the debt, the value of the assets is above, we are going to repay it fully. But if the value of the assets is below the value of the debt, we as a limited liability company maximum can give all the assets. We will never bring money of the company owners. So the blue line is the payoff of the debt. In terms of financial options, you can easily see it's very similar to a short position in the standard put option. If you want to complete the picture and look at the value of the probability of distribution, this is this yellow part. The area, the yellow area, is the probability of default. Now, when we look at the value of equity, we have this green line. It's a completion. So the blue line plus the green line must give us a 45 degrees straightforward line. So this is the whole value of assets. They're all financed either by equity or by debt. So this is the standard Mertens model, which shows that equity position is equivalent to a call option, and debt is equivalent to a safe bond, government bond, which does not depend on the situation of the company, minus a put option on the assets. So this is the main conclusion of the Mertens model, and this is what we are going to do. So let me just show how we are going to utilize it. I'm going to show you two different approaches and explain the difference. One approach is a very standard approach, how to value a forward contract. When we have a forward contract, we can look at the period. We are the company, we need a long-term loan. We can do it in two ways. We can either take today a very long loan and hope that everything will be fine, or we can take a much shorter loan and complete it with a loan commitment. So we are going to take a short loan now, hopefully paying lower interest rates, and we are going to sign a forward agreement that will guarantee at the end of the first loan, instead of returning money, we will get another loan, which will allow us to complete the period. So it can be seen the following way. Either we take a long loan at some interest, let's say Y2, or we can take a shorter loan and complete it with a forward contract. Then, using very simple non-arbitrage argument, we can easily see that the forward rate is equal to this one. This is not what we are going to use, and I'm going to explain why. Our main claim is that loan commitments are actually complex options. And there is a very important optionalities on both sides of the distribution, and this is exactly what we are doing. So let me explain how it works. So forward agreements versus line of credit. Forward agreement is what I showed you a minute before, and it's a strict obligation on both sides. We as a company are obliged to take the loan, and the bank, as a financial institution, they must provide us with the money. In reality, the situation is quite different. In reality, there is a lot of optionality. First, there is a probability that we are going to be in default. If my company is going to be in default by the end of the first period, no bank will give us a loan. So banks actually, they don't have to give us a loan if meanwhile we are in a bankruptcy. On the other hand, if the situation is so good that we can find a cheaper loan, we don't have to go to this bank. We can tell the bank, you know what, you promised to give us a loan at 6%. Meanwhile, we can raise money at 5.5%. So we're not going to use your loan. So there is a lot of optionality on both sides. And this is exactly what we are going to value. So there are 4 different areas. The first area, A, is default. If the company is in a default, the bank will say, you know what, we're not going to give us a loan, to give you a loan. The second area is D, on the right side. If there are better options, if the situation of my company is so excellent that I can find a cheaper source of funding, I will use it. So also here the loan commitment is useless. And in addition, this is what we claim, there is another area, typically small area called B. This is the area responsible of material adverse change. If my company is not in a default, but it's close enough to default, so there is a real question of solvency, whether we are solvent or not, then the bank can actually come up and say, hey guys, there is a clause in the agreement saying that if you are too close to default, we are not going to give you a loan. So this is our way to value it. So there will be a small area called B, where again, this loan commitment is useless. So the only area which is relevant to us is area C. Now, how it is going to look? Now we have a similar picture, the same x-axis with the value of assets, but here we are going to show you the fair interest without a loan commitment. Yes, please.
The last chart was what is just the y-axis? Is it?
It's just it's probability distribution. It is a probability distribution, and here we have the yield. Yeah, here we have the yield. This is the fair yield. If the value of the assets is something, I can tell you what should be the yield given the debt and maturity of the debt. So usually it looks like this. The higher the value of the assets, the lower is the interest. It's still above the risk-free rate, but it goes down. On the left of F, we are in default, so there are no interest rates that can compensate the lender. So it actually goes to infinity. But the red line is the yield on debt. Yes.
And the left and right side, is that free? Is it like free of charge?
No, it's not free of charge. You pay. When you enter the loan agreement, you pay all the time, even if you don't use it. There are 2 types of payments. For an outstanding loan commitment, you pay a small fee. As Dan explained, small fee is actually about $50 billion a year for US economy. So it's not such a small fee, but you pay a few basis points. Then when you use it, you start paying much higher interest rates. What we are going to show that the bank will not give you a loan if you're in this area because you're in a default. We as a company will not want to take the loan if we are in this area, if we can find a cheaper source of financing. So what actually happens, if we are promised this level of yield, this is the number written in the loan agreement. In the loan agreement states we are going to take a loan at 6%. So this is 6%. From this point to the right, we can raise money at below 6%. So we will not use it. So this area is also irrelevant for the valuation. So here we can borrow cheaper. We are not going to use the loan commitment. In this area, the bank will say, you know what, you're already bankrupt, go away. And in addition, there is a small area where bank will just refuse to give us a loan because they can do so. So what is left is only this part. This is the only relevant part. In this area, the loan commitment has value, and it can be high. If you signed the loan agreement a long time ago when interest rates were very low, today it's probably very valuable. So this is the shape of the payoff of our function, and now we are going to construct it based on standard complex options. Now, given the time that I have very little, I will just jump a few slides forward. So in Merton's theory, as I showed before, a bond, a corporate bond, is equivalent to a short position on a put option on the assets of the company. So if we can force somebody to give us a loan, so we can force the bank to sell us a short put, which is equivalent to a call on put. So it's a compound option. It's very similar to compound option, to a call option on put. And this is how we are going to show it. Corporate debt is risk-free debt minus a put option on assets. So letter of commitment is an option to take a loan or to sell corporate bond. Somebody will give us money and we will give them a commitment. So we have an option to sell a short put, which is equivalent to an option to buy a put, call on put. So it's a compound option. The formula was developed a long time ago by Geske and then by others. So this is a standard payoff of a call on put. It's similar to what we are looking for, but it's not exactly the same. So now what we are going to do, this is the payoff of a call on put. So we are going to use two call on puts. We are going to take long the green line and short the red line. When I buy green and I sell red, I get this position. So the yellow line is what we already built, and it's almost what we need, but we have to fix this part. We have to reduce it to 0. So in order to do this, we use another complex option, which is like binary option. So minus a binary put, so this is the solution. Call on put 1 with this strike, minus call on put 2 with this strike, minus a binary put will give us a loan commitment. So this is a complex option, but this is an analytical formula. And there are billions of dollars unreported, unmeasured, and now they can be done. So the formula is long, call on put 1 minus call on put 2 minus a certain amount of binary option, a formula. Let me give you just an example. Let me start with a picture. This is probably easier, and then I'll have to finish. So the dotted line is the value of the loan commitment at maturity. Then this line is 1 month before maturity, and this is 1 year before maturity. First, we can see that it's non-monotonic. In different areas, unlike standard options which lose value with time, in some areas the value will increase with time. In other areas it can decrease with time, since it's a complex position. We long some options, short others. But this corresponds to the general intuition. When the situation is bad enough, it's valueless. When the situation is too good, it's also valueless. And in some area, it can be very valuable. And then we have several examples how it behaves. Unfortunately, I don't have enough time, but like the impact of material adverse change, if the area where the bank can use this material adverse change condition increases, the value of the loan commitment obviously declines. So this is an increase by 10% of this area. We immediately move from the blue line to the red line, which has a much smaller value. And this is the impact of leverage. The bigger the debt, usually the bigger is the value of the loan commitment. But when our debt is too high, it also goes to 0, since there is a high probability there will be a default. And this graph shows how to value the loan commitment when only part of our debt is financed through a loan commitment and the rest is a regular bond. I think I can stop here. If there are any questions, you're welcome either to ask me now or to use the break. And I hope that we are almost on time. Thank you very much.